Welcome, everyone, and thanks for joining us. I'm John Lowell. I'm a partner and consulting actuary based in Atlanta with October 3 Consulting. With me today is Brian Donahue, also a partner and consulting actuary with October 3 and based in Chicago. We're here today to talk about our monthly pension finance update, something that Brian has been working on for a fair amount of time. He's here because he is really the brains of our pension finance update, as well as, frankly, the heart and soul of it. Brian, can you talk a little bit about exactly what the pension finance update is?
Yeah, thanks, John. The pension finance update crudely measures stock market performance versus interest rates. Those are the two key capital market variables that are the major determinants of pension volatility. When stocks go up, pension finances improve. Stocks go down, pension finances deteriorate. Everybody understands that. But interest rates play an important role as well. When interest rates go up, pension liabilities go down. You're making a promise to make payments in the future, and the higher the rate, the less expensive that promise is. And then vice versa, when interest rates go down, liabilities go up. So that interest rate, that's the part of the equation that is often overlooked. And it's what we capture in the pension finance update. So this is something I've been doing for more than 20 years, in part because it's been a very volatile century for pension finance. Things can change really quickly. And in order to consult effectively, you need to know where you stand today, not last January 1st. So publishing a monthly update, which I've been doing for 15 odd years, was really just a natural outgrowth of that effort of that tracking of capital market variables. So nowadays, lots of consulting firms, they weigh in with their monthly updates, and everybody's got their own spin, but they're largely telling the same story. So that's pretty much the history.
Thanks, Brian. And that feels like a really great segue into 2022. I think it's fair to say that 2022 has been one of the most unusual, if not the most unusual year we've had, certainly during my career, with regard to pension finances and pension funding. You want to talk about a little bit what's made it so unusual?
Yeah, sure. It sure has been a very unusual year. So, I think the way to understand 2022 is to go through the variables of interest that we've identified. The first thing we would look at is the stock market. That's the headline variable. If you look at this table here, you see that through November, stocks have lost about 15.5%. That's on a diversified portfolio. And depending on what kind of stocks you're invested in, if you're in tech, a lot worse than that. So there's a lot of variability around that, but all flavors of stocks down double digits this year. But as we see when we look at the this other graph, interest rates, we've got two graphs up here that show the pattern of interest rate movements this year. So on the left, there's a yield curve that really shows interest rates from 0 to 30 years out where they were at the beginning of the year. And you can see rates were under 3%. More currently, you see rates hovering in the 5% range. The graph on the right boils that down to a single rate to show you that for typical pension sponsors, we're using rates below 3% at the beginning of 2022 and above 5% currently. So that's a 2.5% increase in interest rates. Nothing like that this century. So again, that's the underappreciated part of the story. So when you put those two things together, right, you look at the asset and liability performance. Here we've got the two plans that we track in our finance update. The plan on the left, a traditional plan, while assets are down more than 15%, you can see the liabilities are down even more than that. The other plan we track really does more of a hedging LDI strategy. So you really expect a pretty tight match between assets and liabilities. And that's what we see, both down again about 20%. So net, stocks are down 15%, but it's probably a flat to positive year for typical pension sponsors, right? So these graphs show the funded status for a plan that was 100% funded at the beginning of the year. And you can see that a traditional 60/40 plan is through November up more than 8% this year. One final point here, just around the variability. When we look at the pension liabilities down here, we see there's a real wide range, 16 to 27% down. So an important thing on the liability side to understand is what is the duration of your liability, because long duration plans will see a much bigger drop in liability this year than shorter duration. So yeah, definitely a year for the books.
That's really interesting. Brian, one of the things that I got from your last answer is that the way plan sponsors should be thinking about their plans as they come to the end of this year and enter 2023 is it really varies based on their plan design, based on their investment mix, based on whether the plan is ongoing or frozen. Is that true? And if it is, can you talk about that a little bit?
Yeah, that's right. That's the spirit of this whole pension finance update analysis suggests that sponsors are sort of swimming in the same water, right? And they all have a similar type of experience. And there's a lot of truth to that. But this year, particularly, the specific characteristics of plans will lead to very different results. Like we said, some plans are going to think they're going to end the year flat. Other plans are going to end the year well ahead. So plans that are heavily invested in the stock market, you can see that's probably not been a great investment. But again, depending on where if they're in more overseas markets, maybe they've done a little better this year. So you really need to understand what kind of stock portfolio you have. If you've been engaged in the LDI investment strategy with bonds, with investing in long duration bonds, that probably has not been a great year for you asset wise. Companies or the plans that have done best would be plans that have a significant portion of assets in traditional fixed income. So, that shorter duration, 5 or 6, those fixed income assets haven't fallen nearly as much as liabilities. Plans that keep a lot of money in cash, plans that fund, that look for kind of a real return, hedge funds, real estate's more stable type returns, probably outperforming what we're seeing in the public markets this year. So yeah, there's a whole array of variables on the asset side that are going to influence individual plan performance. And you just need to understand, where your plan is with respect to those variables. On the liability side, as I already mentioned, that's where we're seeing huge differences. So if you've got a short duration plan, say the plan was frozen 15 years ago, it's largely retired, most of the benefits are going to be paid out in the next 20 years. The liability on that plan probably hasn't fallen much. Or similarly, if you've got a cash balance plan where your duration tends to be pretty short, right? You really haven't seen the drop in liabilities in those plans. So those plans are going to be hit harder. At the other extreme, an open ongoing plan that's got future benefit accruals and a long duration, those plans have seen dramatic drops in liability this year and will probably grade out among the best performers.
So as we close out the year, once again, if you could give people 3 takeaways for the upcoming year, what should people be thinking about now as they prepare for 2023? Should they expect, for instance, their funding, their required contributions to be going way down?
Yeah, you might think that. We've sort of suggested that it was a neutral to positive year, or has been for most pension sponsors. But that's not how these things are always going to shake out, particularly when you look at the funding rules, where you have funding relief and you have a lot of smoothing. So I think these sort of things are going to affect most to all plans. So I think this notion of understanding where your plan is early, sitting down in January and planning out the year is going to be more important this year than it is typically, just because of the strange 2022 we've experienced. So for example, John, minimum contributions are likely going to be higher than what we thought a year ago. What happens here is, right, assets have fallen, which is going to increase required contributions, but the increase in interest rates, we don't really pick that up for minimum funding purposes because we're already under funding relief. In fact, rates have moved so high that they're basically in the same range as the funding relief rates. So when you look at 2023, for minimum funding purposes, AFTAP purposes, your assets are likely to be down and your liabilities are likely to be flat. So that's something you want to prepare for and not get blindsided for higher funding requirements. Related to this, there are a lot of plans that are going to have to do smoothing calculations, 24-month average calculations. If, for example, you are under the alternative PBGC method, you're going to get walloped. Your liability that you measure at 1/1/2023 is going to be well above a market liability because of the 24-month average interest rates. And you're going to have to pay PBGC premiums on underfunding that's artificial. So that's something that you need to know. And what can you do about that? There are some strategies you can pursue to address that situation. Similarly, there's a PBGC 4010 filing requirement for plans that fall below 80% funding. Similar phenomenon here. Your assets are down, but your liabilities are based on a 24-month average. So we're going to see pressure on that. I think that deadline, you're looking at March 31st. So more than ever, like taking stock and understanding where you are in January is going to be really important for tackling some of the challenges that we see on the horizon in 2023. The final thing, I guess I'll just reiterate, know your plan. Depending on your liability characteristics and your investment portfolio, it's hard to say exactly what kind of a year 2022 was. Relying on these pension finance updates or these general market commentaries may not be good enough. You probably need to understand what's going on in your own plan. So I think those are the key messages.
Thanks, Brian. That's really helpful. So we'd really like to thank you for joining us today. If you have any questions, including questions about your plans in particular, or if you have suggestions for us, please feel free to contact us. And with that, I hope you'll be here again next month to join us as we report on the year end and the year ahead for 2023. Thanks so much.
Thanks.